Hello everybody. In this time we are talking about what is an asset. An asset are a resource controlled by the enterprise as a result of past events and from which future economic benefits are expected to flow to the enterprise. Put another way, assets are valuable because they can generate revenue or be physical items such as machinery or intangible such as intellectual property. Assets are reported on a company's balance sheet, one of its key financial statements. Assets underpin a company's ability to produce cash and grow. They are categorized based on specific characteristics such as how easily they can be converted into cash and their business purpose. They help accountants assess a company's solvency and risk, and they assist lenders in determining whether to loan money to a company. And then, who needs to know about assets? Assets are at the heart of any business finances. So, business owners and members of a company's finance team need to understand their company's assets intimately. Accounting often involves looking at the relationships between assets and other key metrics of a business is finances like revenue, liabilities, and equity. And then we move to asset classification. The one or the first is current assets. Current assets are assets that are expected to be turned into cash within a year. Current assets include cash and other things that can be used as cash. Accounts receivable, inventories, and prepaid expenses. Accountants look at inventory and money out to the business regularly. On the other hand, it's easy to figure out how much cash is worth if there are signs that accounts receivable might not be paid. They will be written down, or a company may eliminate an asset that is no longer useful. And then the second, fixed assets. Fixed assets are things like plants, equipment, and buildings that will last long. Charges made regularly are used to change how old fixed assets are. Depreciation is the name for this cost, which may or may not show that a fixed asset makes less money. Generally, accepted accounting standards let you figure out depreciation in two main ways. The straight line method says that the value of a fixed asset decreases throughout its useful life. On the other hand, the accelerated method says that the value of the asset decreases more quickly in its first few years of use. The third, financial assets. Financial assets consist of investment in the assets and securities of other institutions. Financial assets consist of stocks, bonds issued by the government and corporation, preferred stock, and other hybrid securities. The valuation of financial assets depends on the classification and motivation of the investment. The fourth, intangible assets. Intangible assets are valuable things that you cannot see or touch. Patents, trademarks, copyright, and goodwill are all part of this. Intangible assets can be amortized or tested for impairment every year depending on the type of assets. And then what are the features of an asset? The main features of an asset are: the first, ownership. Assets signify ownership or control by the business for purposes of production. The company can sell these assets in exchange for cash and cash equivalents. The second, scrap value. An asset starts to depreciate over some time due to wear and tear or obsolescence. After a few years, the asset becomes non-functional or obsolete and has no use for the business. But it still has some salvage value which the company can realize by selling it to a scrap dealer. This value is known as the scrap value of an asset. The scrap value generated by selling this asset is an indirect income for the business. The third, economic value. Every asset has an economic value, and this asset can also be exchanged or sold in the market. The fourth, estimation. estimated useful life. An asset has an approximate lifespan during which it can function efficiently. For items like machinery, which are essential for the production of goods, the estimated life is either known to the vendor who sells the asset to the company or a qualified professional who calculates the lifespan based on the asset's present condition and estimated usage. The fifth, resource. Assets are a resource that can generate revenue for the business. For example, machinery can enhance the production capacity of the firm, resulting in economic benefits. The sixth, depreciation. Depreciation is a reduction in the book value of an asset due to factors like wear and tear or obsolescence. It is an ongoing process that terminates only at the end of an asset's useful life. And the seventh, maintenance costs. Most assets have a maintenance or repair cost. Regular maintenance helps the asset to run smoothly and not hamper the business operations. If an asset breaks down temporarily or permanently, it leads to substantial revenue losses for the organization. So, assets are an essential part of any business, and they are needed to carry on production activities for the firm, which will bring in revenue. It can also generate income by selling or leasing to other parties. I think it is enough for this session. Don't forget, give this channel with your like, comment, subscribe, and don't forget, share. Thanks for watching. Thank you.